Before we start this video, do like and subscribe to our channel and not miss on any updates.
Accounting Standard 11, we are talking about foreign exchange. A lot of time what happens is companies which are now here, when I am giving examples, I will give you Indian specific examples so that you can manage that well in the examination as well, right? So let us say there is an Indian company, assume it is Infosys or TCS, whatever company, right? Infosys is in the business of technology or software that we call. Infosys has customers in United States. Now these customers they buy services from Infosys. Now when Infosys sells services to the US customers, generally what happens is international trade, when you look at, they are denominated in dollars. Denominated in dollars means Infosys, when they sell products to the United States or the customers of United States, what happens is they will bill in dollar. Let us say $10,000 is the amount. Okay. Now tell me, what is the exchange rate going on right now between USD INR? What is the exchange rate? Are you tracking it? Or even if you are not tracking it, if you can give an estimate. 84, 85. Okay, I think it touched or it is about to touch 85. Anyways, so for our easier calculation, we'll put it at 85. Right? Now, when I am invoicing in $10,000, when I am saying that $10,000 is the invoice value, right? This, when I have to record in my books of account, I have to record in INR. I have to record in INR because Infosys has to present its financial statements in INR. Right? So what Infosys has to do is this $10,000, it has to convert to INR and record in its books of account. So assume it is 1st of January of 25. Infosys sold $10,000 worth of services. While passing the journal entry, that is customer account debit and sales account credit, if I have to do, I cannot say $10,000, I have to convert that into INR. Accounting Standard 11 gives us a guidance as to what should be that rate when we are recording. Now here assume today's rate is 85. We will record at this rate of 85, $10,000 into 85, 85, 0000. So that is 8,50,000. 8,50,000. And sales will also be recorded at 8,50,000. How to calculate GST and all of that? That is handled by goods and service tax. And generally in case of export, in most of the cases, GST is not leviable. Okay, so, and even if it is leviable, it is refunded and all of those things works out. So don't worry about that. Don't mix both concepts. Here it is customer debit to sales 8,50,000, 8,50,000. Right? Now, after the sale has been made, assume that the due date is 6 months. Due date is 6 months. Now 6 months means was from January till June. The due date is 30th of June of 25. And in between we have this wonderful date which is 31st of March of 25. When I say wonderful date, it means one of the most important dates that we talk about. 31st March of 25. This is my financial year. Now I have to receive $10,000 on 31st March. I don't know what is the value, and on 30th of June I don't know what is the value as on 1st of January. As I reach to 31st of March of 25, what the standard requires is if there are any monetary item, you have to record it at closing. Now, what is monetary, what is non-monetary, that we'll understand subsequently. But for now, just understand that if at all there is a monetary item, which is an account receivable, $10,000, the standards require that this $10,000 has to be valued using the closing rate. So, which rate? 31st of March of 25. Assume on this date, the rate was 84. The rate became 84. Now, tell me one thing. When I sold, the rate was 85. On 31st March, the rate became 84. Is it good for me or bad for me? Earlier it was 85 per dollar. So if I receive money, I will receive 8,50,000. Now, if the rate has come down to 84, I will receive only 8,40,000. So this results in a loss. This results in a loss. How much is the loss? 85 minus 84 multiplied by 10,000 is my loss. So this loss becomes 10,000. So what the standard says is this loss of 10,000 on this item you have to recognize. So when I recognize loss, I will debit P&L or I will debit exchange loss 10,000 to customer 10,000. And in the balance sheet, I will say customer is not at 8,50,000. Now in the balance sheet, the customer will be shown at 8,40,000. Okay. That is the second thing what happens in case of a foreign currency transaction. Then on 30th of June, assume the rate became 87. The rate became 87. Now I am very happy because I thought I would have received at 84. Now I am receiving at 87, which means there is a gain to me. How much is the gain? Now here, don't make this mistake. Gain will be current rate 87 minus, sometimes students go back and take 85. You should not do that. You should take the previous rate at which you have valued the customers. What is the previous rate? 84. So 87 minus 84 multiplied by 10,000. How much is my gain? My gain is 3 into 10,000, 30,000. This gain I should recognize on the date of settlement. So the gain, when I recognize, I have to increase the value of my debtor. See, if there is a loss, I have to reduce the value of my debtor. If there is a gain, I have to increase the value of my debtor. So debit customer 30,000, credit gain on foreign exchange 30,000. So customer, what happens? From 8,40,000 plus 30, it becomes 8,70,000. And when I receive $10,000 at 87, it will be debit bank $10,000 multiplied by 87, which is 8,70,000. Credit customer 8,70,000. Okay, this is the one of the fundamental transaction adjustments that is required by Accounting Standard 11. This concept has been tested time and again for 2 to 5 marks in the examination, and our objective is we should score out of out here. We should score out of out here. Now, in this flow of example, what happened? First, Infosys sold $10,000 worth of services to a US based customer. Now, this dollar transaction is called a foreign currency transaction. It is called foreign currency transaction because it is not happening in my currency. It is happening in some other currency. So this is a foreign currency transaction. Foreign currency transaction initially has to be measured using the rate which existed on the date of transaction. Now, if that rate is not available, or if the rate is pretty volatile, or if an average rate indicates that the average rate represents the rate on different dates of transaction, you can use an average rate as well. Okay, this rate will be given to you in the question. This rate will be given to you in the question. So initially you have to measure using a foreign currency, the exchange rate on the date of transaction. Then two important things: at every financial year end, you have to remeasure all the monetary items. What is monetary, what is non-monetary, I'll explain to you. We already had the discussion once earlier. And on the date of settlement, if you receive more, it is gain. If you receive less, it is loss. So for you to remember, there are two scenarios: imports, exports. If rate increases for imports, it is always a loss, and for exports it is a gain. So if rate increases, when I say rate increases, USD INR exchange rate from $1 is equal to 85. If it increases to, let us say, 87, then there is a loss for imports, there is a gain for exports. That is why when the currency depreciates, when INR moves from 1 to 85 to let us say 1 to 87, this is called depreciation of INR. Sir, but the value is increasing. No, value is not increasing. Value of dollar is increasing. Earlier, $1 was 85. Now, $1 is 87. There is increase in the value of dollar. Dollar is appreciating. Our currency is depreciating. If at all there is depreciation, there is a loss for importers and gain for exporters. So that is why you will see all these export companies, Infosys, TCS, all the service-based companies who have lot of exports, they are happy when the currency depreciates. All the importers, we import oil, we import other items, they are sad when the currency depreciates, right? That is the first thing. And if the rate reduces, importers will record a gain and exporters will record a loss. So in the exam, if there is an import transaction and if there is an appreciation, if there is an increase in the rate, loss. If there is a decrease in the rate, gain. That is how you have to immediately decide when you see a question. Okay. Then there are monetary items. There are non-monetary items. What are monetary items? Monetary items are those items which are determined in terms of money. For example, account receivable, account payable, loan, bank balance. All of these cases, my amount in money is fixed. Account receivable, I know exactly how much money the account receivable has to give me. Account payable, I know exactly how much I have to pay to the creditor. Of course, there may be bad dates, there may be discount allowed, there may be discount received. All of that is there, but the amount is determined. These are called monetary items. Non-monetary items, amount is not determined. Means, of course, we value them in the balance sheet, but how much amount will we receive or recover from those assets, it is not determined. For example, fixed asset. I may say fixed asset is valued at 1 lakh, but how much amount will I get from the fixed asset? Is that fixed? That is not fixed. Is that, can I determine for sure? I cannot. So, financial assets, investments in shares, right? There also I am not sure of what is the amount that is received. Anything other than monetary gets classified under non-monetary. Okay. Now tell me, inventory. Should I classify inventory as monetary or non-monetary? Inventory, is it a monetary item or a non-monetary item? Yes, please. You can type out. I think my if you're speaking, my speaker is on mute because sometimes there is an external disturbance. Non-monetary. Others? Okay. Though we use inventory, we value it at NRV. The amount that we will recover from this inventory is not fixed. So, this inventory becomes a non-monetary item. The moment you sell the inventory and it becomes an account receivable, that becomes a monetary item. Okay. Now, the principle, the golden principle that you have to remember is that all monetary items have to be restated on the balance sheet date at the closing exchange rate. Okay. So, there will be exchange rate for date of transaction. Then there will be exchange rate for year end and there will be exchange rate for settlement date. Initially, you will record using this transaction rate. Then you will compare year end to this and you will record a gain or loss. Again, year end rate and settlement rate you will consider and check whether there is a gain or loss. Any questions so far? Any questions so far? Okay, no questions? Great. So now with this understanding, let us jump into the important points that we need to remember from Accounting Standard 11. Accounting Standard 11 is applicable for accounting for transactions in foreign currency. Sir, what are these transactions in foreign currency? You sell goods in foreign currency, you sell services in foreign currency, you buy goods in foreign currency, you take loan on foreign currency. All of these are foreign currency transactions. Okay, then it is applicable to translate financial statement of foreign operations. Basically, if you have, let us say, foreign branches or foreign subsidiaries, this aspect of the standard we will do when we cover accounting for branches comprehensively. Okay, so we'll just understand the concept here. Practice will happen when we do branches. And accounting for foreign currency transaction in the nature of forward exchange contract. This, though not frequently tested, two simple concepts you need to remember for the examination. Okay. Now, monetary items are money held and assets and liabilities to be received or paid in fixed or determinable amounts of money. This we already understood. Non-monetary items other than monetary items, fixed assets, inventories, investments in equity share can be tested as an MCQ. Okay. Then foreign currency is a currency other than the reporting currency of an enterprise. Now, if a company is registered in India, we have to report our financial statements in INR. So, INR becomes our currency. The currency other than INR becomes a foreign currency. Okay. Then, exchange differences. Now, what is this exchange difference? We saw an example where we initially recorded at 85, subsequently we valued it at 84. This difference of 1 is called exchange difference. Differences resulting from reporting the same number of units of a foreign currency in the reporting currency at a different exchange rate. Basically meaning same number of units of foreign currency, $10,000. We reported at a different exchange rate, and whatever amount results is that results in exchange differences, right? Then we have a foreign operation. See, if I have branches and all in India, subsidiaries in India, that is my domestic operation. If I have a subsidiary, associate, joint venture or branch of the reporting enterprise, the activities of which are based or conducted in a country other than the country of the reporting enterprise. So if my country is India, anything outside of India, if I have a branch, if I have a subsidiary, if I have a joint venture, if I have an associate, that is called a foreign operation. Foreign operation is divided or classified as integral and non-integral. We'll understand that subsequently. Foreign exchange contract also we'll understand subsequently. What is a foreign currency transaction? Transaction which is denominated or requires settlement in a foreign currency. Denominated means, for example, my invoicing is in dollar, so that becomes a foreign currency transaction. But there may be cases where I say my invoice is in rupee. My invoice is in rupee, but the settlement will happen in dollars. Even if the settlement means I'll receive money in dollars, I'll make an invoice in rupee, but I'll receive money in dollars. That is also a foreign currency transaction. So the transactions of buying and selling goods where price is denominated in a foreign currency, borrowing or lending, becoming a party to an unperformed foreign exchange contract. If I enter into a forward contract or foreign exchange contract, that also is a foreign currency transaction. Or acquiring or disposing of assets, incurring or settling liability denominated in foreign currency. I purchase assets, I take loan, right? All of that is foreign currency transaction. Now, initial recognition we have already understood. It should be recorded on initial recognition by applying the foreign currency amount, the exchange rate between the reporting currency and the foreign currency at the date of transaction. So basically you have to take exchange rate at date of transaction. Exchange rate at the date of transaction. Okay. Now, at each balance sheet date, if there is a foreign currency item, if it is a monetary item, you have to use the closing rate. So monetary item like account receivable, loan taken, loan given, all of that you have to report using the closing exchange rate. Very important, right? Then, if it is a non-monetary item, for example, fixed asset. If it is a non-monetary item, for example, fixed asset, then if you are using historical cost denominated in foreign currency, you will report using the exchange rate at the date of transaction. What does that mean? You might find it complicated, but let us say I imported a car. I have imported a car. This car was imported on 1st of January of 22. And I am carrying it, or I am using the cost model. I am using the cost model or historical cost model. Then, whatever was the exchange rate on this date, I should value the gross block of the car at this rate only. So, for example, at that point of time, if it was 60, just for example, then, and my car cost is $1 lakh. So I should value the car at 60 lakhs. I should not subsequently restate if I am using the historical cost model or cost model. Whereas if I am using the fair value model, that is, let us say if I am using the revaluation model, then I will report using the rate when the fair value was determined. What does that mean? For example, I am using the revaluation model for my car. Okay. Now, if I am using the revaluation model, I have to calculate the fair value. Let us say fair value on 31st of March of 24 for this particular car was $90,000 fair value. Then, if I have to convert that to INR, I cannot take 60. I have to take rate on 31st of March. So 90,000 into, let us say, 70. That is the value at which I will recognize the car if I am using the fair value model. And if there is any contingent liability denominated in foreign currency, I will use the closing rate. So to summarize, there are three categories only: closing rate for all monetary items, closing rate for contingent liability. Closing rate for all monetary items, closing rate for contingent liability. Then, if I am using cost model, I will use the transaction date value. If I am using revaluation model, then I will use the rate on which the fair revaluation or the fair value was determined. Now, one more example of this non-monetary item. Let us say I have inventory. And inventory is valued at, let us say, net realizable value because it is lower than cost. So when I'm determining NRV, I should use the exchange rate on the date I have determined the NRV. Okay, is that part clear on non-monetary item? I have to take the rate on which I have determined the NRV and also the value on value when I have determined the NRV. Is that clear? Okay. Right. Now, what do we do with the exchange differences? An exchange differences results when there is a change in the exchange rate between the transaction date and date of settlement of the item. This we have already understood. Right. Now, all exchange differences other than the exceptions that we talked about, okay, we'll talk about the differences. Generally, the rule is you will take it to P&L. Generally, the rule is that you will take it to P&L. But yes, if there is something called as non-integral foreign operation, or if there is a long-term monetary item where the government has allowed capitalization, in that case it is different. But generally, you will take it to P&L. Exchange differences on settlement of monetary items of an enterprise at which they were initially recorded during the period, and monetary items reported in previous financial statement. Basically, what it means is all the monetary items you should recognize as income or expense in the period in which they arise. You should recognize in the period in which they arise. So, account receivable, account payable, loans, whenever there is an exchange difference on these items, you will recognize that in the P&L. You recognize that in the P&L, both gain as well as losses. Okay. Now, if rate of transaction is 1st of January of 25, 31st March of 25 is the financial year end, and 30th of June of 25 is the settlement date, then what you will do is from this date to this date, this is called unrealized gain or loss. This will also go to P&L. From this date to this date, whatever you get, this is the realized portion, and this unrealized also get realized subsequently, but this is already recorded. So realized portion here will go to P&L. So the thing to remember is if the transaction is settled in the same period, entire gain or loss will be taken to P&L. If the transaction is settled in the subsequent period, then you will only take the gain or loss between this period. Means from the year end till the date of settlement. Okay. So that is one thing you have to keep in mind. Now, there are some exceptions to the monetary items discussions that we had. And what about non-monetary items? See, non-monetary items, if I am purchasing, for example, fixed asset. If I am purchasing a fixed asset, okay, I am not required to remeasure it. I am not required to remeasure it. So please understand. If I am purchasing a fixed asset, I paid $10,000 or I didn't pay. I took a loan. Okay. I spent $10,000 to buy this fixed asset and I have taken a loan of $10,000. This loan of $10,000 is a monetary item. This has to be remeasured. This fixed asset of $10,000 is not a monetary item. This will not be remeasured. So if this is not remeasured, there is no question of getting a gain or loss on this particular item. That is one thing you have to keep in mind. Second thing is, even if you are doing fair valuation, you are doing the revaluation part as per accounting standard 10 and not as per accounting standard 11. So that will be a revaluation gain or loss. Right? Now, earlier what used to happen is, when I took foreign currency loan, and the standard what I said, you have to remeasure the monetary item and the gain or loss will be recognized in P&L. Any loan you take, I have taken a foreign currency loan, the gain or loss on that foreign currency loan should be recognized in the P&L. Very simple, straightforward. Okay, there was no dispute. But what happened is during 2008, okay, just around that time, there was a crisis and INR depreciated significantly, and also INR was volatile. So I have taken $10,000 at, let us say, 30. Suddenly the rate became 35. Then again the rate became 32, or suddenly the rate became 40. There was a huge depreciation of INR against the dollar. And I'm not talking about $1,000 or $10,000. If companies like Reliance or if companies like Tata's and L&T, if they import a lot of items, then, or if they have a lot of foreign currency borrowings, their P&L was significantly getting impacted because of exchange rate volatility. Okay, that is the background. So what the government came up and said, the government introduced one paragraph called 46A subsequently and said that if there is a long-term monetary item, if there is a long-term monetary item, what is the meaning of long-term monetary item? Maybe I have a loan taken. It is a long-term loan. If there is a long-term monetary item which has been incurred to acquire fixed assets, what the government says is, for this long-term monetary item, whatever is the exchange loss or gain, or whatever is the exchange difference, default choice was to take it to P&L. If you want, you take it to P&L. But if you don't want to take it to P&L, what they said is, this exchange gain or loss, you can adjust, you can add or reduce from the cost of fixed asset. So what it indirectly meant is, let us say I spent $10,000 to buy a fixed asset. Okay. Then, of this $10,000, I took a loan, long-term loan of $10,000. For example, when I took the loan, the rate was 35. Now the rate is 40. This is the closing rate. The closing rate is 40. Now this difference of 35 to 45 into 10,000, the loss is how much? 50,000. The default choice or the earlier accounting standard applicable, or even now Ind AS when it is applicable, this 50,000 of loss, you have to take it to P&L. This is the default thing. But because of this paragraph 46A, entities have a choice that instead of taking this loss to P&L, you can add it to the cost of fixed asset. Now, what do I mean by that? See, $10,000 was spent to buy a fixed asset. So fixed asset will be $10,000 into 35. That is 3,50,000. Right? Now this loss, first choice is debit P&L, credit loan 50,000, and 50,000. Basically, transfer the loss to the P&L. When I say debit P&L, exchange loss. 46A gives us an option that if you want, don't take this to P&L. Instead of debiting it to P&L, use that amount to add to the cost of fixed asset. So basically, in conclusion, any exchange loss which is incurred on a long-term monetary item which is related to a fixed asset, I'll come to depreciable and non-depreciable separately. If it is related to a fixed asset, just remember this, then the cost or the loss or gain, it is a choice, okay? All the exchange differences should be added or reduced from the fixed asset. So the loss, instead of taking to P&L, you have a choice to either add it to the cost or reduce from the cost. So why will you reduce from the cost? If there is a gain, you will reduce. So basically, loss you have to add, gain you have to reduce. From what? From fixed asset. This is as per the choice given by paragraph 46A of Accounting Standard. Remember this paragraph. Huh? If this question comes, write 46A and come. Okay, that will actually make a very good impact on the examiner. So if there is a long-term monetary foreign currency item, if it is related to a depreciable asset, I gave you an example of fixed asset, but now if it is related to a depreciable asset, then the exchange difference arising on reporting of long-term monetary items, if they are related to acquisition of a depreciable asset, can be added or deducted from the cost of the asset, and subsequently depreciation will be calculated considering the revised cost. Sir, can we take it to P&L? Yes, that P&L option is always there. But if the entity wants, and it is not revocable. Huh? Once you have decided that you will take it to P&L, next year you can't come. Once you have decided that you will take it to fixed asset, next year you cannot come and say, no, this year we will not take it to fixed asset, we will take it to P&L. Losses will add to fixed asset, gain will transfer to P&L. That is not allowed. That is not allowed. So you can either take it to P&L or you can add it to or deduct from the cost of asset. That is if it is a depreciable asset. If it is a non-depreciable asset or if it is related to some working capital and all of that, but such technicalities are not tested. If it is in other cases, then you will create something called as foreign currency monetary item translation difference account. FCMITDA, foreign currency monetary item translation difference. Foreign currency monetary item translation difference account. So you can accumulate in FCMI TDA account and amortize over the balance period of the long-term liability or asset by recognizing in the income and expense. So basically what it means, for example, if it is land, okay, I have taken a foreign currency loan to buy a land and the loan is 5 years. There is an exchange difference. There is an exchange difference. I don't want to take it to P&L. What can I do? Because land is non-depreciable, this exchange difference has to be accumulated in foreign currency monetary item translation difference account. Then over a period of 5 years, I have to amortize it and take it to P&L, every year. So what is the advantage of this? The advantage is the earnings are smoothened, especially when the currency appreciation and depreciation is very, highly volatile. Then in that case, it will help us to have even earnings. So instead of recognizing, let us say 10 crores of loss in the first year itself, you will split that over, let us say 5 years, 2 crores, 2 crores, 2 crores, 2 crores, 2 crores. So the losses get evenly smoothened out. Okay. Now this was given as an option, and they thought initially they will wind it up by March of 2020, but this has kind of become a permanent option itself, right? 46A for long-term foreign currency monetary item. Okay, this is the table. Compulsorily you have to remember. Yes, realized P&L is from initial recognition till date of settlement, but because you have already recorded unrealized P&L as on 31st of March, only from the period of 31st March to the date of settlement, you will record in the subsequent. Okay, any questions here? Before we move to the actual questions, any questions? Okay. Now, we'll take a few questions before we move ahead to the remaining part of the chapter. BK Limited purchased a fixed asset costing rupees 5,000 lakhs on 1st of April of 2012, payable in foreign currency USD on 5th of April. Sorry, very careful with the dates. Okay. Now, what is the date? Here they have said 1st of April is when they are purchased. Settlement is the 5th of April, means after 1 year. Exchange rate of $1 is rupees 50 and 54.98 is on 1st of April and 31st March. So, 1st of April of 12, the rate is 50. 31st of March of 13, the rate is 54.98. Now, what have we done? We have purchased, we have imported. Rate has increased. If the rate has increased, means there is a loss to us. Okay. This should, over a period of time, come automatically to you. As with you keep on practicing, not only for exams but also for real life. If I imported, rate has gone up, loss for me. So it should trigger automatically. Okay. Then the company also obtained a loan of $100,000 on 1st of April 12, payable in 3 equal annual installments. First installment was due on 1st of May. We are required to state how these transactions are to be accounted for in the books of accounts for the year ended 31st March of 13. Right. Now, first date of acquisition 1st of April. Cost of acquisition 5,000 lakhs. Now they have given in INR, but it has to be paid in dollar. So what is the value? Value is 5,000 lakhs divided by 50, 100 lakhs. Okay. Then we have also taken a loan. Now here you may argue, sir, they did not tell us that this loan is for the loan or not for the loan. Okay. So now we have to make some assumptions and solve the question. If this loan is taken on 1st of April and payable in 3 equal annual installments, means what? And interest has not been given. So let us keep interest aside. 100,000 is taken on 1/4/12. So 100,000 is taken on 1st of April, payable in 3 equal annual installments. The first installment will be due when? First installment will be due on 31st of March of 13. That is the first thing. And here also, this 5,000 that has been incurred on this is payable in foreign currency on 5th of April. So here also there is a restatement required, right? And will we restate the fixed asset? We will not restate the fixed asset. So fixed asset which is recorded at 5,000 lakhs will continue to remain at 5,000 lakhs unless there is a loan which is taken for the purpose of acquisition. Okay. Creditor dollar value is 100 lakhs and we have purchased on 1st April, we have to restate on 31st of March, so there is a loss. What is the loss? Loss is 54.98 minus 54.98, that is the loss. So the creditor payable consequent to reinstatement is 4.98 into 100 lakhs, 498 lakhs. Okay. Now this is a long-term monetary item. This is a long-term monetary item. Sir, how do you say it is long-term? More than 1 year. Now, this exchange loss of 498 lakhs, I can debit it to P&L. That is the first treatment. Or I can take the forex fluctuation and capitalize this loss to the cost of fixed asset. Why? Because paragraph 46A gives me an option that if I have incurred a long-term monetary item and there is an exchange difference on that, it is relation to acquisition of a fixed asset. So the loss can be added to the fixed asset cost. Okay. So in that case, 498 will be added to the fixed asset cost. Clear? Any confusion here? Okay. Then what about this $100,000? They have said there is a loan of $100,000. Now what happens is, out of $100,000, we have 33,333.33 repaid and 66,666.67, this is outstanding. When we repay, we repaid it at 54.98 and this outstanding also has to be remeasured at 54.98. Can I say entire 1 lakh should be remeasured at 54.98? When we took, it was at 50. Now it is at 54.98. So the loss is 4.98 into 1 lakh. So in the second case, the $1 lakh of loan into 4.98 is the loss. Now, how do I treat this loss? Again, they have not said whether we have used it to buy the asset or something else. So again, you can give both the option. You can charge it off to P&L, or if there is a depreciable asset, you can add it to the fixed asset account. So first option, 4.98 lakhs has to be debited to P&L. 4.98 lakhs has to be debited to P&L. That is the default option. Sir, we can make assumption that it is in respect of acquisition of a depreciable asset. Then we can add it to the cost of asset. If it is not in relation to depreciable asset, the other option that is available is to debit it or transfer it to foreign currency monetary item translation difference account, FCMI TDA account, and amortize it over the life of 3 years, 3 years of the loan period, right? So this is one question which revises whatever we have done. I'll do one more question that is from compiler. Very nice question. And the thing there is, if at all such kind of question comes in the examination, you should be able to do it. See, it has been asked for 5 marks, slightly long question as far as 5 marks is concerned. And one suggestion is, if you feel that there are too many numbers and it can be confusing to you at times, then you can park it off for subsequent handling. Means you can do it subsequently. Okay, no need to break your head and lose time. You can do it subsequently, but even if you attempt it 70-80% correct, you will get good marks. Okay, explain briefly the accounting treatment needed in the following cases as per AS 11 as on 31st of March of 20. Data include amount due from Mr. S, rupees 9 lakhs, recorded at the prevailing exchange rate on the date of sales. Transaction recorded at US dollar 172. US dollar 1 is 73.5 on 31st March, and US dollar 1 is rupees 72.5 on 1st of April. Okay. Now, here they have not told what is the date of sale. Okay, what they have assumed? Initial recognition only they have assumed. Okay. So we'll assume that this transaction is during the period, because if it is from the previous period, 72.5 becomes relevant, but here it is at 72. So we recorded it at 72. On the closing date, the rate becomes 73.5. So 72 to 73.5 rate has increased. When you have sold, when you have exported, if the rate has increased, it is beneficial to us. Now, when I say rate has increased, I am talking about dollar rate. Dollar rate has increased from 72 to 73.5. So there is a gain. How much is the gain? Gain of 1.5. Now, how to account for it? See, they have given us in lakhs. First, we have to convert this to dollars and then see what is the gain. So, dollar value of sale is equal to 9 lakhs divided by, on the date of transaction, it is 72. So, 9 lakhs, if I do 9 8 is 72, 1 lakh. So, 8 is 64, 8 9 is 8, 8, 12 is 96. So 12, 1, 2 and 40 is 12,500. Yeah, 12,500. Okay, you use your calculator, no need to do manually. I make sometimes mistakes also, but I like to do it manually. So 12,500 is what? Dollar value. It has increased from 72 to 73.5. So the gain is 1.5 multiplied by 12,500, that is equal to 18,750. Very simple. 1 mark or 1.5 mark, you will directly get it here. There is no confusion. Now, second part of the question is slightly not very complicated, but if you approach it step by step, you will be able to do it. Long-term loan was taken on 1st April from a US company amounting to 75 lakhs. 5 lakhs was repaid on 31st of December 2019, recorded at US dollar 70.5. Interest has been paid as and when debited by the US company, and they have not told the interest component. If they tell interest, it gets covered under AS 16, other complications arise. But at CA intermediate level, you don't expect to get so much of complication. 73.5 on 31st of March and 72.5 on 1st of April. Now, they have taken loan of how much? 75 lakhs. First thing is to calculate dollar value of the loan. What is the dollar value of the loan? 75 lakhs is the value, INR value, and the exchange rate is 72.5. Why? Because we have taken the loan on 1st of April, so we should know that the value on the date of recognition is 75 lakhs divided by 72.5. So if I do 75 lakhs divided by 72.5, I get 1,03,448. I get how much? 1,03,448.28. This is the dollar value of loan taken. This is the dollar value of loan taken. Now what has happened is we have repaid 5 lakhs. They should have actually given in dollars, but yes, we have repaid 5 lakhs at 70.5. So please hear this out clearly. 5 lakhs has been repaid at 70.5, which means $7,092.2 has been repaid. So out of this total loan of 1,03,448.28, we have repaid 7,092.2. So how much is left? 96,356 is outstanding. 96,356 is outstanding. I am repeating once again. First, 75 lakhs of loan is taken at 72.5. So the dollar value becomes 1,03,448. Out of this loan, we have repaid 5 lakhs at 70.5. So we have repaid 7,092. So the balance loan is 96,356. This has to be restated. And on this 7,092, we have to see whether there is an exchange gain or loss. Now, at what rate did we borrow? We borrowed at 72.5. At what rate did we repay? 70.5. So here there is a gain. And what is the closing rate? Closing rate is 73.5. So on this amount, there is a loss. Two components. One, 7,092 we repaid at 70.5. There is a gain. And on the outstanding balance amount, there is a loss. Okay. So 96,356.08 multiplied by 73.5 minus, we have taken it at what value? We have taken it at 72.5. Right? So this becomes 96,356.08 multiplied by 1. Sorry, 72, not 72.5. It is taken at 72. So this multiplied by 1.5. Did I miss out something? The loan was again. Loan was taken at 72.5 and the closing rate is 73.5, not 72. I don't know why did I take 72. I got confused because of this. So it is 72.5 only. So 96,356, which is the balance amount of loan, you have 96,356. That is the loan value. Okay, the loss. Then there is a gain. Why is this 92? Just give me a moment. It cannot be. Okay, so exchange difference loss net of adjustment of exchange gain on repayment has been calculated. Alternative considering otherwise also is possible. So what they have done is they have considered this 5 lakhs whatever has been repaid. So this is not an appropriate adjustment. 70.5. Why 70.5? That is for this gain transaction. This I am talking about loss. Okay. Then, as far as gain is concerned, we have repaid how many dollars? $7,092.2 multiplied by 72.5 minus 70.5. So the gain is 7,092.5 multiplied by 2. So the gain comes to 14,185 on the date of settlement. That is the first thing, right? Second thing is, here this is incorrectly done. This is as per the suggested answer, but this is incorrect because this 5 lakhs of repayment includes gain. This 5 lakhs of repayment includes gain. We have to exclude that gain and do the accounting. So loss is 96,356.08, that is 96,356. Gain is 14,185. So net loss is equal to 96,356 minus 14,185. So 96,356 minus 14,185, if we do, it is 94,830. Sorry, 82,071. This is the net loss. Now the problem in this answer given as the suggested answer is, I cannot reduce the entire 5 lakh from my outstanding because 5 lakhs includes gain component. 5 lakhs includes gain component. So you have to, don't do it that way, but do it this way, that this is outstanding multiplied by 1 and the gain that was recognized earlier, 14,184. So basically they are doing double counting. This 5 lakhs include 14,184. So you cannot include that gain. You have to use the amount without the gain. So the net loss is 82,071. I think I have to report this question too. They are given a note also anyways. Exchange different loss, net of adjustment has been calculated in the above solution. Okay. So that is what they have done, which is incorrect. Now, what is the treatment? Treatment is either debit to P&L or transfer to foreign currency monetary item translation difference account. Okay. Then number 23, 5 marks. Such a simple question if you see. 5 out of 5 is possible. Okay. Karna Limited, an Indian company, has the following foreign currency transactions during the financial year 22-23. On 1st of July, imported goods from Tri Limited, a German-based company, amounting to rupees 30,96,000. Amounting to rupees 30,96,000. So, on 1st of July, import has happened, amounting to 30,96,000. On 1st of October, imported plant and machinery from another company, German-based company, for euro 18,500. The amount was paid on the date of import. So, immediately they are paid. Then, on 1st of December of 22, exported goods on credit to Cream Limited, a German-based company, amounting to rupees 50,40,000. All the transactions were recorded in the books of account at the prevailing exchange rate on the date of transaction. Ignore taxes and duty. Payment due from Cream Limited and payment due to Tri Limited is outstanding, means both these amounts are outstanding. Rate of exchange is on 1st of July, 1 euro is 86, 1st of October 88, 1st of December 84, 31st of March 90. To show the value at which the above items will appear in the balance sheet as on 31st of March, to calculate the amount of gain or loss in each of transaction on account of exchange difference. Now, 1st of July 22, rate is 86. How much is sold? 30,96,000 is sold. How many euros? Divide by 86. So you will get the euro value. That is 30,96,000 divided by 86. 36,000. Then on 31st March, rate is 90. So on 31st of March, you will show 36,000 into 90. 36,000 into 90. So the first case, 36,000 in euro into 90, 32,40,000. Okay, that is the first thing. Then what will happen to gain? There is a, what is this? This is imported. So there is a loss. So loss will be debited to P&L. Okay. Then second, on 1st of October, imported plant and machinery for 18,500 amount was paid on the date of import. 1st of October 18,500. 1st of October 18,500 into 88. So the plant and machinery will be shown at 18,500 into 88, 16,82,000. Now, will we restate this? See, this is a non-monetary item. Non-monetary item is not restated. Non-monetary item is not restated. It will be shown at the same value itself. Of course, subject to depreciation, they are not given us information. Then, or on 1st of December, exported goods at 50-40. 1st of December rate is 84. So what is the value? 50-40 divided by 84, 60,000 multiplied by 90, 54 lakhs. So this 54 lakhs will be, the closing balance, and in the import there is a loss which will be reported. On the export there is a gain, that is 54 lakhs minus 50 lakhs 40,000. There is a gain of 3 lakhs 60,000. So this 3 lakhs 60,000 will be shown as gain. Okay, simple question. There are 3 bits to it. So most likely the segregation would be 2 marks, 1 mark, 2 marks in this particular question. ABC borrowed $5 lakh on 1st of July of 17, which was repaid on 31st of July of 17. ABC Limited prepares financial statement ending 31st of March of 17, not 1st of July. This is 1st of January. Rate of exchange is 68.5, 69 and 70. You are required to pass journal entries in the books of ABC. Now, here, should we assume it is for a fixed asset or should we assume it is for a normal case? Enough information is not given, so you can assume, you can directly take it to P&L. When you take the loan, bank account debit 5 lakhs into the exchange rate to loan account. On 31st March, INR value has, the USD rate has increased, means there is a loss to us. Loss of how much? $5 lakh into 1. So 5 lakh is the loss. Foreign exchange difference account to foreign loan account. Then this will be transferred to P&L. P&L debit to foreign exchange difference. Then on settlement, it is 70. So what you will do, you will compare 69.5 and 70. Here is the difference of 0.5. This 0.5 into 5 lakhs is the loss, and amount paid through bank is 5 lakhs into the closing rate of 70. And the loan account balance is 347.50. Okay. Now this type of questions, if they come again, you should be able to score good marks here. This we have done similar question already, again for 5 marks it was tested. Branches will do subsequently in the branches chapter, not now, so that you have clarity. Okay, any questions? Now, this part again is covered also along with branch accounting. Foreign operations classified as integral and non-integral. Now the thing is, sometimes the question does not give us clear indication, so we can assume based on the information given, we can assume whether it is integral or non-integral, right? Now what is integral? Integral means, think of something like a body, okay, human body. This hand is integral to my body, means it is just an extension of my body, right? So when we say integral, it is something which is fully dependent on the head office. So if there is a lot of dependency, sir, how do we get to know whether it is dependency or not? They purchase goods from head office only. Okay, they get continuous, they get inflows from head office, they get money from head office, sales are remitted back to head office immediately. If that is the nature of transaction, then it is called integral operation. Whereas if it is a non-integral operation, the entity will purchase, the branch, the subsidiary, they will purchase goods from outside. That is not integral. Okay, so for something to be a non-integral foreign operation, then The foreign operation should have significant degree of independence, means they are working independently. They are not dependent. Now, if I have to give, if I have to extend the example, till the time you are studying, till the time you become earning on your own, you are dependent on your parents. But after you start earning, you start becoming independent. That is how you can understand. Then the transactions with reporting entity are not large in number. So between the head office and the branch office, there are not frequent transactions. There are only limited transactions that you can see. Cost of material, labor and other expenses are paid or settled in its local currency. So the non-integral foreign operation will carry out lot of transactions in its local currency only, not in the head office currency. Sales are mainly not in reporting currency. Whose reporting currency? Reporting currency of head office. So they are handling sales independently. They are collecting amounts in foreign currency. They are keeping the amounts with them only. They are remitting only partially. Sale price are determined based on the local competition. So if it is an integral foreign operation, sales price and all are determined by head office. Whereas if it is non-integral, they will take their local conditions, they will take their local surroundings, how the things happen in the environment, business environment, and accordingly they decide the price. Activities are funded either from profit, from its own operation, or from local borrowings. Sometimes they may take money from head office. It is not that they should not take, but largely it is self-contained. Largely it is within the local economy. So if you have to understand, if there is a US based company, let us say there is Domino's, for example. Domino's has Indian I'll not call it branches, I'll call it outlet. There is a company which runs it, or it gives out franchise, right? Now, a lot of things other than the brand, a lot of the money, lot of money that comes, a lot of sales that happens, the taste, the preferences, that everything happens locally. Then this we can say is a non-integral foreign operation. Same way Amazon India, Amazon US. Okay. Now Amazon India works as per the local conditions in India. So again, that is a non-integral foreign operation. Right? Now, when it comes to translation of integral foreign operation and non-integral, we'll just give a quick reading. In detail, we'll understand in the branch accounting chapter. Now, what is the meaning of translation? What happens is the foreign operations, the branch, the subsidiary, it has to be incorporated in the head office. So, if I have a branch, the branch information has to be incorporated in my books for preparation of financial statements. Right? Now, if there is a foreign operation, the foreign operation will prepare its trial balance in, let us say, dollar. Now, the dollar amount, I cannot directly add it to my Indian trial balance. So, what should I do? I should convert. Or this is also called translation. The difference between conversion and translation is, the difference between transaction and translation is, in transaction, I am entering into a transaction. In translation, I am taking just a trial balance and I am converting that into my INR value. Okay. Translation for integral. Integral means it is fully dependent. It is an extension of my own office. Everything is as if I am only doing. So in that case, individual items in financial statement are translated as if all the transactions had been entered into by reporting enterprise. So if it is an integral foreign operation, I am assuming that I am entering into the transaction. And accordingly I will translate. So when I do the translation, what I will do? I will take the exchange rate on the date of transaction, or I may take an average rate as well. Okay. Then for fixed asset, exchange rate on the date of purchase. For inventories, date on which the cost was incurred. If there is a recoverable amount of an asset, if you have to determine, for example, if you are talking about impairment and all, or if you are calculating NRV and all, rate on which the amount was determined. Right? So very simple, translation of individual financial statement items as if I am entering into the transaction. So whatever the sales I do using that rate, purchases I do using that rate, all of that will be as if I myself am doing the transaction. Then if it is a non-integral foreign operation, then it is slightly different. Here you have to remember a lot. So the balance sheet items, closing rate, asset and liabilities. Okay, equity of course remains as it is. Income and expenses, rate on the date of transaction, you can use an average rate also. exchange differences is accumulated in something called as foreign currency translation reserve account. If there is any goodwill, closing reserve, again this is a balance sheet item. If there is any contingent liability, closing rate. So basically what you have to remember, balance sheet items, asset and liability, closing rate, and income and expenses item, rate on the date of transaction or the average rate. Okay. This classification, reclassification, all of that we'll do when we do the branch accounting. Right? Now, very important part of forward exchange contract. Now, what is this forward exchange contract? Let us have a quick understanding. Say for example, we teach CFA. When we teach CFA, we buy some subscriptions from Kaplan. We provide this to our students. To Kaplan, we have to make payments in US. So let us say today you purchased a course, and say for example, I have to pay $1,000 to Kaplan. You made the purchase today, 1st of January of 25, for example, and I have to make the payment to Kaplan on 31st of January of 25. Now this $1,000, I have to convert, when I pay, I have to incur in INR. But I don't know on this 31st of January whether the rate, today the rate is 85. If it becomes 87, I am at a loss. If it becomes 84, I will gain. But my business is not to make gain or loss out of foreign exchange differences. I want to safeguard my cash flows. So what do? I go to a bank, or I can go to the market also, and I say, I want a contract. Now I need dollars to buy dollars on 31st of January of 25. The bank says you pay, or you have to pay 85.5. Sir, why not 85? See, bank also does not want to take a risk. Okay, there is a huge interbank market which works on. So the bank says you have to pay me 85.5 on 31st of January and take $1,000. This is called a forward contract. This is called a forward contract. Now, the difference between today's rate and this rate on which we have agreed, if this amount is higher, it is called premium. And if the amount is lower, it is called discount. Okay. So what has happened? I am sure that I have to pay 85.5 into 1000, that is 85,500 to settle the transaction. 85,500 to settle the transaction. Now the question is, if the rate comes down to 84, even then I have to pay this amount. If the rate goes up to 87, even then I have to pay this amount. I am not here to make money on exchange differences. I want to safeguard my cash flows. Okay. Now the contract entered into to buy a foreign currency at a future date is called a foreign currency contract. The difference between the spot and the forward rate which is agreed is called either premium. If the amount is less, it is called discount. Okay. This is the concept of forward contract. Now the accounting treatment depends on whether it is speculative or non-speculative. So what is the meaning of speculative and non-speculative? Non-speculative means I am entering into the transaction to safeguard myself. I don't want the risk of paying extra. That is non-speculative. Speculative means I am entering into the transaction to make gain or loss because of exchange rate differences. I want to make money because of exchange rate differences. For example, even if I don't have to pay money to Kaplan, I can go to the market and buy USD futures. Okay, similar to forward, but I can buy. And if the rate increases, I make money. That is what speculative. Now, if it is non-speculative, the premium and discount at inception should be amortized over the life of the contract. Means, if for example, if it is 3 months, 1st of February 25, settlement happens on 30th of April of 25. It is 3 months, 1, 2, 3. Premium is, let us say, $1 into 10,000. Okay, so the total premium has to be split between 3 months. So till here, 31st of March of 25, I have to recognize in the current period, and the balance I have to recognize in the subsequent period. Okay, that is one. Then any exchange differences. So the rate movement between this date and this date, the exchange difference has to be recognized in P&L. Premium and discount amortized. Exchange difference recognized in P&L, and if at all you cancel or renew the contract, that is also recognized in income and expense. This you can just ignore it. Only these 2 points. If you are thorough, it is sufficient. Whereas if it is a speculative forex contract, speculative means what? I don't want to safeguard myself. I am just entering into the transaction to make money because of exchange rate differences. Then in that case, the foreign currency amount whatever I have entered into, and the rate on the date versus the rate which is contracted, whatever are the changes, that is gain or loss. For example, if I have entered into to buy a forward contract and the forward contract has moved, the gain or loss whatever arises will be mark to market and recognized in P&L. We will do an example and understand this. Premium and discount is ignored. So let us look at this example. This one. Sterling Limited purchased a plant for $20,000 on 31st December, payable after 4 months. The company entered into a forward contract for 4 months at 48.85. On 31st December, the exchange rate was 47.5. How will you recognize the profit or loss on the forward contract in the books for the year ended 31st March? Now here, I am entering into this contract to safeguard my position for this amount, the dollar that is purchased. So, what is the forward premium? On 31st December, the spot rate is 47.5 and you have agreed to buy at 48.85. So, difference between 48.85 and 47.5 is the premium. 1.35 into 20,000 is my premium. So, 1.35 into 20,000 becomes 27,000. This 27,000 is for 4 months. So, what we will do from December, that is 31st December, 31st January, February, 29th February and March, 3 months, 27,000 into 3 out of 4, that is 27,000 into 3 divided by 4, 20,250 will be amortized in the year ended 31st March of 12 and the balance will be amortized in the subsequent period. So 20,250 will be recognized as forward premium expense for the year ended 31st March of 12. Okay, that is one thing. Powertrack Limited purchased a plant for 50,000 payable after 6 months. Company entered into a forward contract for 6 months at 64.25. On 31st October, the exchange rate was 61.5. So again here, 64.25 minus 61.5, the difference is 2.75 multiplied by 50,000. The total loss, or this is not the loss, you call total premium, is 137,500. Out of this 137,500, 5 months will be expensed in the current period and 1 month will be expensed in the subsequent period. Okay. Now, how do we value the gain or loss? Okay, so how do we value the gain or loss? What happens is, you will see, you have entered into this contract at 64.25. Okay. Now, company entered into a forward contract for 6 months means what? I want to buy. Let us say on 31st of March, this rate has now become 65. Means what? I am gaining. Okay. So that gain, if at all it happens, that gain will be recognized in the P&L. Of course, at your level, such concepts are not tested. Okay, those questions are not tested. But if at all there is any gain, that will be recognized in P&L. So what is the use of this gain? See, when you finally settle the transaction, assume for a moment, when you settle the transaction, the rate is 65. You are settling on 31st of March. So there is a gain on the forward contract and on the payable there is a loss. So the gain and the loss will get offset. That is why it is called non-speculative. Now for you, no need to venture so much into details regarding these entries. Generally, premium is tested. If at all they test for gain or loss, calculate the gain or loss and recognize in P&L. Same question. Similar question here also. Okay. So we largely covered various types of questions which are tested as far as foreign exchange are concerned. Disclosure, you can have reading. FCMI TDA, very important as far as examinations are concerned. Okay, I am not overemphasizing, but this can be a pretty good scoring chapter when it comes to examination, right? So now what we'll do, we are done with this. We'll start with Accounting Standard 4 and follow up with Accounting Standard 5 tomorrow. AS4 will start, we'll complete whatever we can and we'll start with Accounting Standard 5 subsequently. Just give me 2 minutes, I'll move the files and we'll continue. If you have any questions in the meanwhile, you can ask.